Mahantesh Sabarad, he is joining in from SBI Cap Securities. Good afternoon, Mahantesh, and what a great afternoon actually it really is turning out to be as we're building onto those gains and now looking at 9,500 on the index. Do you think that the move that we're seeing is justified, or there is quite a mismatch between, the macros, the overall situation that businesses are seeing vis-a-vis what the market seems to be reflecting?
Good afternoon. Thanks for having me on the show today. As far as the markets are concerned today, I think, yes, the 9,500 that we are seeing on the Nifty is indeed a good move from investors' point of view. And we don't think that there is any mismatch between the index levels versus what the financial performances of the various companies are going to be. Mind you, we are already seeing the lifting up or partial lifting up of the lockdown in our country, and that's reviving the economic activity. From a valuation perspective, if one were to gauge into the future, perhaps there will be damage to the earnings, but the kind of earnings damage that we are forecasting versus the valuation that we are seeing, we are not too expensive. Perhaps we are trading in that 16, 17 multiple range on a forward basis, and that's not too expensive for the market at 9,500 levels.
Mahantesh, just a word on the kind of names that are holding out today and the kind of weakness that you saw in the names of late. The fact that the financials were taking a huge beating for, up until as late as the last two trading sessions. The failed TLTRO, a lot of concerns about NPAs, retail deluge, and NPAs actually kicking in. What is it that you're making of whether or not investors should relook as to how to approach NBFCs at this juncture?
So between the BFSI space, there is a distinction that has been clearly being made between the banks versus the financial institutions, which are the NBFCs, the non-banks. And yes, from an investor perspective, non-banks or NBFCs are really in we really don't know what's going to happen. They are into trouble because their spreads will be compressed, their NPAs will be elevated levels, their funding sources are questionable, and we also have promoter-led issues in certain NBFCs. So all these factors are playing a little bit of havoc on NBFC names. And it's clearly the banks which would tend to do better in these terms. The failed LTRO that you have talked about is of concern for NBFCs because funding sources are not easily coming through for most NBFCs. So on all these aspects, which are the primary business aspects of NBFCs, spreads versus NPAs versus growth, capital availability, and promoter-led issues are all of concerns. We would rather stay away from the NBFC sector and primarily focus on the banks.
Sure. Okay, that's the word on financials, which today, of course, are soaring high. About a good 1.5% up move is what you're seeing on the Nifty right now. Most sectors contributing. There's only FMCG and cap goods to some extent, which are seeing that slight shade of red. Axis Bank is the troublemaker today. That's down about 4%. There's also Hindalco, Asian Paints, DRL, Titan, as well as Nestle. They are seeing some ebb off come in. What happens, Mahantesh, to the pattern of consumption from here? Paints, for instance, in the slowdown that we've been grappling with for the last year and a half, even pre-COVID, one saw that paint volumes continued to stay intact. In fact, most of the companies in the previous quarter actually posted an uptick, which is why you saw paint stocks fall the least in the last, weakness as well in the market. But do you think that will get completely challenged now? And do you need to reduce your exposure to the paint sector? Or is it going to be the other way around? If indeed these stocks were to fall, one should treat them as a buying opportunity?
Well, I think it is indeed a buying opportunity for most paint companies, simply because the raw material costs are very low for them. Their raw material costs are linked to crude oil prices, and we are seeing there is sustained downturn in crude oil prices. Pre-COVID too, we had a situation, there was a supply glut creating pricing pressure, and that's the single biggest factor that we will look forward to as far as paint companies are concerned. So margin expansion, the gross margin expansion is something which will add to the profitability of most paint companies, irrespective of what leverage they can get, the operating leverage they can get through the growth. Growth in terms of volumes can return to the paint sector probably later in the year, not immediately. And paint is such a sector that wherein you will have pent up demand catching up pretty fast. So you may have a lull in terms of demand until the economic activities resume, but the pent up demand will help the volumes shoot up, and most paint companies therefore will be able to do better. So I wouldn't advise getting out of paint companies. In fact, any fall is indeed a buying opportunity for the paint companies.
All right, stay on with us, Mahantesh. Lots more to chat about. Let's just get a bit of a move on and focus in on strategies then. And Morgan Stanley, Rhythm Desai has come out with their latest report on the outlook for the market, saying that as of now, the bear market may not be over. Let's take it across to Pankaj, who joins in with all the details. And Pankaj, also run us through the portfolio rejig, which stocks have been added and removed.
Rhythm Desai of Morgan Stanley has written a note where he says that bear market in India may still not be over. Maybe the time-wise correction in India would tend to continue. However, he also says that sector and leadership positioning will change once this bear markets get over and once you start to see a rally. So the sectors that were earlier leading the markets may not be the one that lead the market. And he's saying that already, you've seen signs that some of the sectors have started to show leadership. So for example, consumer discretionary, healthcare, maybe the leaders of the next rally is what they are predicting. They have removed from their model portfolio names like Godrej Consumer, HDFC, MCX from their focus list. On the other hand, went ahead and added Sun Pharma, Apollo Hospital and Lupin as a part of their focal list. They have trimmed financials overweight to about 500. Financials now become neutral. Consumer staple now becomes about 200 basis point underweight after this removal, and healthcare has added about 500 basis points and 300 overweight. 300 basis point is now the overweight. So Sun Pharma, Apollo, Lupin, all three have become a part of their overweight. They are saying that sector leadership will change as this bear market gets over, and healthcare and consumer discretionary may actually go ahead and lead the market rally when it happens.
Thanks very much, Pankaj, for giving us those details on the Morgan Stanley report. Meantime, the churn in the markets could make you question your investment portfolio at a very volatile and uncertain time such as this, but this is the time to keep the faith and stick to your SIPs. That's the timeless mantra worth revisiting once again. And here's none other than the big bull, Rakesh Jhunjhunwala, saying that you should remain invested in your SIPs in good times and even in the bad.
We don't expect a return of more than 12 to 18% from equity markets. This is not the Mahalakshmi race course. And if you invest in a SIP, I'm confident over a period of 8, 10, 15 years you will get it. And don't try to be over smart. And I think SIPs should form an integral part of everybody's savings.
All right, that's the view coming in from Rakesh Jhunjhunwala, and it's sound advice really at a time like this when a lot of investors are getting unnerved by the kind of rates that you're seeing on the screen and the acute spikes of volatility. Well, let's get a move on then and focus in on SpiceJet as well. We understand that the company is undertaking cost-cutting moves. Remember, the aviation sector has been hit hard on account of the pandemic with absolutely no travel. Many pilots, we understand from SpiceJet, will not be paid for the months of April and May. Let's take it across then to my colleague Utkarsh Chaturvedi, who joins in, and clear ramifications then of the lockdown. Utkarsh, what's the status when it comes to pilot salaries for SpiceJet?
Well, the SpiceJet has written a letter to all its pilots today saying that except the pilots who flew the cargo planes, they will be given their salaries for the block hours. All the other pilots will not be getting their salaries in April and May. But they have gone ahead and spoken about the fact that how, most of their flights, even though the flight with seats, which are the passenger carriers, have also gone ahead and, done cargo flights. They are looking to increase that. They're also looking to get more and more pilots to fly these planes so they can keep to keep flying their planes. April and May especially will be something which they'll be looking at. Interestingly, in the letter they nowhere spoke about the time to come by when they expect the things to be normal. But clearly, at a point of time when Indigo really rolled back all of the salary cuts, Air India employees are now the pilots and the unions have written to the management that their pay cut should be rolled back at this point of time by they're taking a decision that no pilots will be paid for April and May is a bit interesting at this point of time. We have to really wait and watch how many pilots have flown the cargo and what is the amount of outgo. We are expecting a response from SpiceJet. SpiceJet hasn't responded to our query, but has been saying that they will come up with a response. We're waiting for that response of SpiceJet also to come in a while.
Okay, that's the word coming in from SpiceJet. Utkarsh, thanks for much those details. I can see some flashes coming in on Motherson Sumi as well, saying that majority of their plants are operational again globally. That is what agencies seem to be reporting. And remember, this is also one of the key, movers of late. Has had a volatile session, but today on my screens I can see an Ashok Leyland, Bharat Forge, Motherson Sumi. These are actually holding up in trade. But to the other pocket, Mahantesh, do you think aviation, exhibition stocks, these are going to be the obvious casualties in the post-COVID world? Because I think it'll be some time before people are going to get back to flying unless extremely essential, or for that matter, go to a public place like a movie theater or a mall.
Absolutely. I think it's going to take a lot of effort for these companies, airlines to malls to restaurants to really regain their business. There will be a tendency wherein there will be postponement of such consumption. We often see that consumption is driven in such sectors by impulses. So you have impulse traveling to impulse dining, etc. Those demand aspects will be curtailed. Airline industry will be particularly very, I would say, very badly hit. They have used fixed expenses, fixed costs to bear. Aircraft lease rentals are the biggest chunk of single block expenditure that they have to meet, and that amounts on even in normal circumstances close to about 14 to 18% of their revenues. And the crew or employee cost is another similar chunkier block, which is about 11-12%. So for airlines to meet these kind of fixed expenses, the lease rentals, the employee costs, under curtailed flying conditions, under lowered revenues, is going to be a big challenge. And I think it's going to take a long time before any of these sectors really revive. And there will be a question mark in terms of their revival post-COVID.
Sure, absolutely. Just looking at some of the other names as well, and I want to check in on what Reliance is up to ahead of its earnings tomorrow, as well as that decision on rights issue. Mahantesh, would you say that most of the positives are already in the bag, especially post the FB deal and the kind of debt reduction that would lead to? Or do you think, depending on the rights issue pricing, there could be a further flurry of a move on Reliance?
So first, a disclaimer here, I own Reliance shares, and coming back to your question, the way we have seen the stock rise in the past month or so seems to suggest that most of the positives are indeed getting priced into the stock. Of the Nifty 50 stocks, since the lockdown began from March 24th till yesterday, Reliance was best performing stock, up by almost 60% since that 23rd March price of Reliance. And no other stock is so even close to it. Perhaps a Cipla, which is at 59.5% gains, is the next best performing stock, but all others are way behind. So this stock movement of Reliance tells me that most of the positives are already getting priced in. We don't know the details of the rights issue, but rights issue would definitely lead to the debt reduction strategies or that the management has outlined. This will be the second step towards that, the first being the Facebook deal. And if and when Reliance really becomes debt free, it will be a great company to have. Again, a must-have stock in portfolios.
Yeah. All right, Mahantesh, we'll let you go on that note. Thanks much for your views on the market.
Thank you.
Moving on.